Welcome students to the series of lecture for CFA and FRM. And today we are going to start a series of lecture on currency because in CFA and FRM both you have to study the currency as in the quotation of the currency. You need to study that what are the different types of exposure you can have in the currency with the spot market and the forward market. And then you have to have a very good understanding of cross currency swaps. Okay, with that, we are starting this series of lecture on currency exposure and currency risk management. And today, our specific topic or a specific agenda is to understand the quotation in the currency market, in the currency instrument. And this is critical. The reason for this is because in different book and different curriculum, different quotations are being used. And it's slightly tricky, and the possibility of making mistakes are pretty high when you deal with currency. So today we'll focus on the quotation. First, we'll focus on the quotation for the spot market, and then we'll focus on the quotation for the forward market or future market. Okay, so first of all, quotation. And we all know that when we talk about currency, we talk about two currency. If I say INR, USD, there are two currency. So the currency which is in the denominator is called as base currency. Okay. And the currency which is in the numerator is called as price currency. Always. For example, you have AUD INR. It means INR is the base currency and AUD is the price currency. And whatever the quotation is, if you're writing buy or sell, you're always talking about buy and sell or buy or sell of the base currency, not the price currency. Okay. So, for example, I'm saying sell 1000. This is the quotation given at the rate 0.98. It means you will sell 1000 USD, and definitely you're selling 1000 USD. It means you're buying CAD, and to buy CAD you need to convert and use whatever the quotation at the rate quotation provided. So this means you should sell 1000 USD, which is the base currency, and to find out how many CAD you need to buy, you multiply this 1000 with whatever the quotation it has. Instead of sell, there is buy, doesn't matter. If it is buy, it means you buy 1000 USD and you sell 1000 into 0.98 CAD. So that's what is done here. So currently it is sell. Sell 1000 USD, which is the base currency, and therefore buy 0.98 into 1000, that is 980 CAD. So what is the important rule? The important rule is that every time the buying and selling, whatever written, whether it is saying buying or selling, it is about the base currency. And the opposite transaction, if you're talking about buy, then the opposite transaction, that is sell, will happen for the price currency. Okay, so buy CHF. How many CHF? 500. Therefore, you need to sell what? Price currency, which means you have to multiply 500 into 1.07. So you should buy 500 CHF, which is base currency, and therefore you need to sell 1.07 into 500, 535 USD, which is the price currency. That's it. Okay. So the principle of this quotation, that you're buying or selling the base currency, and then you have to find out what the price currency through the multiplication is valid in spot and forward market both. Now, what about bid and ask rule? So this is important. You need to understand bid and ask rule in almost every financial instrument, but in currency, it is slightly important to know because these questions comes in examination. Generally, they don't ask bid ask questions for, say, forward contract written on a underlying asset, that is equity, but they will definitely ask a bid ask questions on currency forward contract or currency spot contract. So it is important you understand this bid and ask rule. So what is this bid and ask rule? In a very simple term, when you go into the market for any financial instrument, there would be a dealer which has a lot of inventory of that instrument. So whenever you try to buy from the dealer, you have to buy at a higher price. And if you try to sell to the dealer, you will sell at a lower price. So at the end, you will always incur a losses if you're transacting with a dealer. And currency market is heavily maintained by dealers. So The rule is very simple. You always buy at a highest price or a higher price and sell at a lower price to the dealer of the currency market. Okay. So it is saying that the principle that you have to follow, that you will always incur losses in the currency market if you're dealing directly with the dealer. So assume the quotation given is the bid rate and ask rate is given as, so they will give you the bid rate and ask rate. So the bid rate is 0.9790 and ask is 0.9810. Okay. And the price and base currencies are CAD and USD. So this is the price currency and this is the base currency. So the question is, if I want to buy 1 USD, if I want to buy 1 USD, which quotation, bid or ask, which quotation I need to use to find out that how many CAD I need to sell. So if the question is, if you want to buy 1 USD, if you want to buy 1 USD, then you need to sell higher CAD. Which one of them is higher? This one. So you have to sell more CAD, and therefore the answer is 0.9810. Okay. And that is what is written here. If you want to buy 1 USD, then you have to pay higher CAD. Okay. Now, if the question is sell USD, if you want to sell 1 USD, one base currency, if you want to sell one base currency, 1 USD to the dealer will not give you 0.9810 CAD. It will only give you 0.9790 CAD. That is what is written here. If you try to sell 1 USD to the dealer, then in return, what you will receive is only 0.9790 CAD, not 0.9810 CAD. And you can understand the difference between the two, whatever the difference is of 0.0020. The difference of 0.020 is the profit for the dealer. Okay. So what do you have to think in the bid ask rate? If the bid and ask rate both are given in a question, you have to pay more to buy a currency and you will receive less if you sell a currency. That's it. Okay. So we talked about two things, that whenever they are talking about buying and selling, it is about the base currency. And there is not only one quotation. There will always be two quotation. There will always be two quotation in the market. Okay. And that is called as bid and ask rate. And it is given because whenever you try to buy in the market, you will buy at a higher price. And whenever you want to sell in the market, you will receive less. Okay. Because currency is predominantly dominated by the dealers. Okay. Now again, quotation. But now the quotation that we'll discuss is not of the spot market, but a forward market. And we are discussing forward quotation. Now you have to find out the forward price or forward quotation from the spot rate and the forward point. So you can find the forward price directly with the help of spot rate and forward point and forward point. Actually, in the market, you won't get final forward price. They will only tell you what is the spot rate of a currency with other currency and what is the forward point. And with the help of these two, you have to find out the final forward price. The simple math is forward price is always be calculated with the help of spot rate plus the forward point. This is a very plain vanilla explanation, but actually it is the forward price is equal to spot rate plus forward point divided by what? Divided by 1, and the number of 0 after the 1 is dependent upon whether the spot rate have 2 decimal places, 3 decimal places or 4 decimal places. So if the spot quotation has 2 decimal places, then you will divide the forward point with 100. If there is 3 decimal places, you will divide by 3 zeros, as in 1000. And if it has 4 decimal places, you will divide it by 10,000. That's it. So let's do a simple math. The spot quote is given as 1.35. The forward point is given as 1.2. You cannot simply add 1.35 plus 1.2. You first need to analyze that how many decimal points we have there. There are 2 decimal points. So what you have to do, you have to divide the forward point with 100. 1 and 20. Why 20? Because there are two decimal places in the spot quote. So 1.35 plus 1.2 upon 100. So 1.35 plus 0.012, that is 1.3612. That is the forward price. Now another example, the spot quote is 2.554 and the forward point is negative 9.5. Can we simply add? No. What you have to do? You have to divide it by 1 and then 30. Why 30? Because there are three decimal places. So 2.554 plus minus 9.5, which is the forward point, divided by 1000, and this is the final forward price. Okay, let's do more example. So you have spot rate of AUD upon EUR. These are the spot rate, and you have to find out the forward rate for 30-day and 90-day. What are given are the forward points. Forward points for what? This is the bid rate, ask rate. So this is the bid forward point and this is the ask forward point. This is the bid forward point and this is the ask forward point. So you will add the bid forward point to the bid quotation and you will add the ask forward point to the ask quotation. So you will add this to this to this, and this to this, and this to this. So let's try to find out the final bid and ask rate with the help of the forward point for the 30-day forward contract. So the spot rate is 1.2571 and the bid rate given is, or the bid forward point is given as negative 1.0. I will divide by how many zeros? I'll divide by 4 because there are four decimal places. Now this is the ask rate. I have to add what? Ask forward point. That is a negative 0.9 and then I'll divide negative 0.9 with, sorry, 1.2574. I'll divide negative 0.9 with what? 40 because it is 1, 2, 3, 4. Four decimal places. Similarly here, I'll divide 11.7 with four zeros and 12.0 again with four zeros. And you will get the bid rate and the ask rate for the 90-day forward contract and the 30-day forward contract. Okay. Now assume at the end, I'm not doing the calculation, assume at the end, this comes to say 11.2560 and this comes to 11.2570. I'm not doing the calculation. This is the forward rate for 90 days, as in the bid rate and the ask rate. And if the question is that you need to buy 1000 euro, then which quotation you will use to find out that how many AUD you need to sell? The answer is simple, that you'll always get what? Losses in the dealer market. So if you're buying 1000 euro, then you need to pay a higher price, right? You need to sell more AUDs. So you will do 11.2570 into what? 1000 and find out how many AUD you need to sell, right? Okay. So what we have learned? We have learned first that when we say buy and sell, it is on the base currency. Second, we understood there is always bid and ask rates or quotes given. This is given because of the dealer market where you will always incur the loss because you will always buy at a higher price and sell at a lower rate. Then we understood that even in the forward market, you will have to calculate the forward price, which you can calculate with the help of spot quote and the forward point. Perfect. But even there, you have to be very cognizant that you have to calculate the bid rate and the, or you can say the bid forward price and the ask forward price. Okay. For the bid, you will be given the bid rate of the spot market and the bid forward point for the forward market. Similarly, you will get the ask spot rate and you will get the ask forward point for the forward market. Okay, so we have covered the quotation and it is important to understand the quotation. In the next session, we'll try to understand the return and risk effect on the portfolio due to currency exposure. With that, I'll pause here. Thank you. Have a nice day.